I'm recording now.
Mm-hmm.
And then I will put the video on the Moodle page so
Mm-hmm.
that you can go back and check it anytime that you want.
Great, thank you.
Okay, so here's the first puzzle for you. If you answer it correctly, you can have as much as 10 points. There is no penalty for having the wrong answer. You buy a car, you are a traveling salesman, and you buy a car for 5,000. You have the opportunity to buy a car for $5,000. If you buy it, then you can earn $10,000 from sales if you are driving around Almaty. But you're having trouble finding a loan that which you can buy the car. There, the loan shark offers you an interest rate of 90%. So would you take the loan at the interest rate of 90% for this particular car? What do you think?
Oh, no. Next week. Mm,
Well, let's see. Um, if you bought a car with a loan, then the cost of the enterprise would be $5,000 plus the
this
interest.
means that,
Sounds good. Go ahead.
so it means that next year, I would have to owe Larry
Yes, you would have to pay off Larry for that. So when,
4,500. Yes.
yes, you borrow $5,000 from Larry, and then he will charge you an interest rate of
Mm-hmm.
95% or
Mm-hmm.
$4,500. Good, exactly.
Mm-hmm.
So
I
would you
think
take the
yes.
loan?
I think yes,
Plus you move.
because I will be better off.
How do you know?
10,000 minus 9,500.
Good,
Yes.
good. Yes, so you are, um, even with such an exorbitant interest rate, you are
Yes.
still doing $500 in profit. Yes, good. So the point of the problem is that maybe loan sharking is all right when there are projects that can earn a lot of money for which you cannot find a cheaper lender. Yeah, good.
Mm-hmm.
So it matters because governments often try to limit the interest rate that can be charged to use the sense of the borrower. But limiting the interest rate may destroy opportunities for high risky profits. Yeah, so I think that problem is worth 10 points. You're up by 10. Okay, so you are thinking about helping to finance a pizzeria in Umbati, but you fear that the restaurant will go bankrupt next year. So the question is, what would you rather hold in assets in the company? Would you rather have bonds or stock shares? And what you move.
Mm. Mm. The hold is with the company will go bankrupt next year. Which will derive home bonds or equity. I think hold bonds
Okay, good. Why?
because the firm should be required to pay back.
Good. Yes, so if the pizzeria goes bankrupt, it will not be able to satisfy all its creditors. But the courts required to pay off the bondholders first. Good, exactly. So that's another 10 points for you. Good. Another question about bonds, this time in terms of the currency of denomination. So Toyota may sell a bond expressed in tenge in New York City. This is a euro bond. Just a question about definition, that's all.
No. So Eurobond
Good. Pasimu.
denominated in a particular currency, yes?
Yes, this particular bond is denominated in tenge.
In tenge, okay.
So the tenge, of course, is the currency of Kazakhstan.
Mm-hmm.
And therefore, if Toyota is selling the bond in Almaty, it is not the euro bond. But if instead it sells it in New York, it is a euro bond because the New York market has as its home currency the dollar. The tenge is a foreign currency. So yes, the New York bond issuance is a euro bond, even though it is not expressed in euros.
Mm-hmm.
Good, so that's 10 for you again. There's a question about uncertainty, in particular adverse selection. I don't know about you, but I find that I'm more likely to lend money to my brother than to a stranger. And the question is why? Why would you rather lend money to your sister than to somebody that you don't know on the street in terms of adverse selection?
I think we should know more about this person.
Yes,
So we have more information about our family.
Yes, you had more information about your sister. Yes, that's right.
Yes. So I will know whether she can pay me back or no, and it will be better than give it for stranger.
Since you had no information about the stranger.
Yes.
Yes, okay, good. Basically, that's the right approach to take. But in terms of adverse selection, we have that one person knows more than the other. In this case, the stranger knows more about whether he can pay you off the million tenge than you know about him. So you're reluctant to lend to the stranger. It's a simple example, but it may help explain why you would rather make loans indirectly to your commercial bank than directly for dealing with the potential borrower. So that's good for 10 points again. And then here's the last puzzle about moral hazard this time. So what do we mean by moral hazard? Just a common sense definition would be fine.
I think that loan sharks are unaffected by the moral hazard.
Did you say unaffected? Why?
Because they can offer risks to their borrowers. Yes.
But yes, but any lender faces the possibility that the borrower will not pay off the loan. So the question is, why would a loan shark worry less about non-payment than other lenders? What is distinctive about the loan shark, like Larry?
Moral hazards?
Okay. What is moral hazard? Yes, maybe we should start with that. Good.
Uh, this is the particular situation where one side can provide information that is misleading about her, for example, liabilities, credit capacity, yes, assets.
Yes, I'm having a bit of trouble hearing you, but I think you're on the right track. The distinctive thing about moral hazard is that it represents a problem that may arise because of the terms of the contract. So, for example, I smoke cigarettes and I'm thinking about picking up insurance on my home. Now, I know that if I have the insurance on my house and it burns down, the insurer will build a new home for me. Therefore, once I take up the insurance, I don't care about the possibility that by smoking in the house, I will create a fire. My recklessness is offset by the insurer's purchase of a new home for me. So whether I just smoke in bed, I don't have to worry about the house fire. It doesn't cost me anything. That's moral hazard.
Mm-hmm.
Now, I come to you, and you are insured, and I ask you for house insurance. If you know that I am a smoker, you are not willing to give me insurance at a low premium because you know that there will be a distinct possibility that I will burn down my own house by smoking.
Mm-hmm.
So maybe you will reject my application for insurance, or maybe you will charge me a high premium for the insurance.
Professor?
Just the high
I'm sorry, I
premium
can't hear you well.
help compensate for the risk of smoking that creates a fire. Exactly. So there's the summary of their answers.
Mm-hmm.
More hazard. And I think that's worth 10 points as well. So you have 50 extra credit points from the puzzles. Oh, one last note to make. The adverse selection occurs before the transaction, such as buying insurance, we took it out a loan. It really reflects the asymmetry of information. The potential borrower has more information than the potential lender about his prospects for non-payment. And then moral hazard is different because it is created by the deal itself. Had you not given me health insurance, I would not smoke in bed.
Okay.
Okay, good. So that takes care of the quiz. The extra credit quiz, you had 50 points on that. Congratulations. And then let's go on to any topics that you have found difficult so far. I think that of the first four chapters, the most difficult is chapter number 4.
Mm-hmm.
So let's talk a bit about present value to begin with. On the whiteboard. So in general, what is present value? Just a common sense explanation.
Mm-hmm. Present value states that money, that some amount of money is
Yeah.
worth more than the same amount, but in the future.
That's very close. So the present value, let's say, of $1 to be received next year is the amount of money that you put in a savings account today to have $1 in 2022.
Mm-hmm.
So, for example, let's say that the interest rate is 10%. Then present value, I'll call it PV, is just the amount of money that you could put in your savings account today to have a total of $1 for next year, including the interest payments as well as the principal. So we want to solve for PV, the present value in this case. So this is just the $1 divided by 1.1, in this case, about 91 cents. If you put 91 cents in the savings account today, you will have $1 next year. And therefore, you are indifferent between receiving 91 cents today and $1 next year. Or as you said, present value is just the value today of money to be received in the future. That's correct. So why do we care about present value in money and banking? Why does it matter? Maybe it doesn't matter.
That if we receive, for example, $1,000 today, it will be better off than we will receive it 1 year
Yes, that's right. Yes.
in the future. Yes.
Yes, good. So one use of present value may be that it enables us to make decisions about whether to buy assets or not. You have another opportunity of that we're earning more than $1 with an investment of 91 cents. You will take that other opportunity.
Yes.
But
So the actual we have 91 cents. We will
okay,
have 91. Yes.
if we put 91 cents in the bank today, we will have $1 next year.
Yes.
So 91 cents is the present value, the value today of the dollar to be received next year. That's good. So in Trimble, we can use present value to compare the values of various assets. Some assets may pay off after 1 year, other assets after 30 years, like a government bond. But to compare the value of those assets, we can take a look at the present value for a given amount of money to be received after a given amount of time. So here's a question for you. What happens to present value when the interest rate rises?
If interest rate rises, it
Let's say
means
the
that
20%. That's good.
the 20%. Okay. So we should $1 divided by
Good.
1.2. Yes.
1.2. That's good. So if the interest rate is 20% rather than 10%, then the present value of the dollar to be received next year is about 83 cents, 83.2, something like that. So there's a reverse relationship between the interest rate and present value. So if the price of the asset is equal to present value, let's say for a bond, we will have an inverse relationship between the interest rate and the price of the asset. Good. Okay, good. That's fine. So here is the last topic that may be troublesome in chapter 4 on real and nominal interest rates. So what is a nominal interest rate or market interest rate?
Nominal interest rate. It's increased in percentage in money that you can pay the lender for the use this money that you borrowed.
Yeah, good. So a market interest rate, for example, in Kazakhstan, would be the amount of interest that you have to pay in pennies to the creditor. Yes. So nominal in this case more or less means monetary or money. What then is the real interest rate?
And real interest rate is a like is a rate that investor receives after inflation occurs.
Okay? But in general, how does
It,
go ahead?
so it means that a real interest rate is equal to nominal interest rate but minus inflation.
Um, or expected inflation. Yeah, good. So the real interest rate is not expressed um, directly in monetary terms, but instead in terms of purchasing power.
Mm-hmm.
So, as you said, the real rate is equal to the nominal rate minus the loss that you have to absorb in purchasing power because of higher inflation.
Mm-hmm.
The expected inflation rate. So this is actually the ex-ante real interest rate. The full payment is realized in purchasing power. Therefore, since we don't know for sure what the inflation rate will be, we have to use our expectation. Good. So here's an example. Suppose that the real interest rate is 3%, and the rate of expected inflation,
Mm-hmm.
as it is today in Pakistan, is about 7%.
Mm-hmm.
Then what is the nominal interest rate?
It equals 10, yes.
Yes, or the real rate plus the expected inflation rate. Yeah, good. So, for example, today in Kazakhstan, the expected inflation rate is about 8% for next year. In the for the best of 2021 in Kazakhstan. And the nominal interest rate at minimum is 9%.
Mm-hmm. So real rate is equal 1%.
It's very, very low. Yeah.
Yes.
So one problem in Kazakhstan is this: since we have very low real interest rates, while people not borrowing more money from the banks, the banks are really scrambling looking for customers. What's the problem? And one possibility may be uncertainty in the economy due to the pandemic. Because I'm not sure what the market is going to be in the coming year, so they don't want to extend their operations by borrowing money. They want to wait and see. Maybe that's the problem of in the macro economy today in Kazakhstan. But anyway, it's just an example of how to use the efficient equation for real and nominal interest rates. Okay, so I think that everything else in chapters 1 through 4 is fairly straightforward. by the way, the puzzles that you work through at the beginning of class will help you in the quiz for next week.
Mm-hmm.
And I'm done.
Okay.
Questions?
Thank you so much.
So, so you have no questions? Then,
No questions. Thank you, Professor.
okay, I will end up the recording now.